Greetings, everyone, and welcome to our webinar on model risk management and generative AI. I am Joanne Barefoot. I'm CEO and co-founder of AIR, the Alliance for Innovative Regulation, and we are excited to be sharing this program with you today. We have collaborated with Google to write 2 papers on model risk management for financial institutions and the regulatory issues involved. And we're focusing today on the second one, which has been tackling the topic of the hour, the ubiquitous topic I think we're all spending time on every day, which is generative AI. We are going to have a fireside chat talking about the program with Daniel Gorfine and Brandon Milhorn. Then we will have a presentation, a summary of the paper from Google, and then we're going to have a panel to talk about it that I'm going to moderate. We are in webinar format. We would encourage you to, if you have questions, we're going to save some time at the end of the session for them. If you'll enter them in the question box, we will answer as many of them as we have time for at the end. I think we are all dealing with the fact that generative AI is the most rapidly adopted technology, apparently, in the history of the world. It's changing all our lives with a speed and a simultaneous impact that makes it unique, I think, among the other things that we've dealt with. We know it's changing financial services, and we know it's going to change financial regulation as well. So without further delay, I want to introduce my friend Daniel Gorfine to lead our fireside chat.
Fantastic. Well, thank you so much, Joanne. And I'm absolutely thrilled to be joined by Brandon Milhorn, who's the president and CEO of the Conference of State Bank Supervisors. Brandon, thanks for joining me, being willing to sit in the hot seat for about 15 to 20 minutes here. I'm going to scrap all the questions. No, just kidding. So why don't we jump right in, and maybe I'll ask you to share a little bit about your background, which is quite unique because you've had experience in the federal government, and I'll call it still your relatively new role with CSBS. So please share with us a little bit about your background.
Sure. Thanks, Daniel. And thank you all for having me. It's I always feel on financial services issues like the newbie. I was a national security lawyer before I came to the FDIC in 2018 with Chairman McWilliams, and spent time there at the FDIC as her chief of staff. Worked for now acting Chairman Travis Hill as a deputy in 2023 before I came to CSBS. Of course, CSBS, we've been around since 1902. Our roots are in banking and community banking for state charters, but we also supervise and license non-banks, money transmitters, mortgage originators, and servicers, consumer finance. So our members really touch components of everything that we do day in and day out from a financial services perspective. We feel like we're on the front lines of protecting the dual banking system every single day. So that's a little bit about me and a little bit about CSBS.
So let me ask you, Brandon, you've been in the role for a little more than a year. Has anything surprised you about the state, banking regulatory landscape? And what should people better understand? What surprises you when you talk to the public or even financial institutions? What do they not understand?
Yeah, I think the one thing that surprised me, because in Washington, a lot of times you hear about, I'll say it now, but the P word, patchwork, that the states are a patchwork, that they're all different. The amount of coordination and consultation among our members is really first rate. Whether we're talking about non-bank supervision and coordinating on exams, thinking about risk to the system, and our members are, just like examiners around the world are focused on policy, are focused on data. They want to get it right, and they're much more coordinated than as a group than I think you sometimes get a sense for in Washington.
Oh, fantastic. All right. Well, let's jump into the primary topic for today, which is AI in financial services. From your perspective, what do you see as AI's biggest impact on the business of banking? And that might be today as well as, 5 years from now. And then my part two is going to be what is that impact going to be on financial regulation and financial regulators? I mean, there's really three parts to it. I'm sorry, I always do that. That's the lawyer in me, three-part questions. So impact on industry, impact on regulation, impact on the regulator.
Yeah. Well, I mean, I think we're just beginning to get a sense of what AI can do in the financial services space. And in many ways, it's just like the introduction of any new technology, efficiency gains, improvements in data processing, improvements in decision making. All of those are possibilities with AI, and certainly with generative AI. When I think about financial services, right off the bat, I think of customer interactions. I think that right now, that's where a lot of the AI tools are being used, whether it's marketing, consumer support, chatbots, fraud detection, things like that. All areas where strong models have historically been used, but where AI is giving us new insights into data and issues. Then I think sort of behind the scenes, just running institutions and making better decisions with respect to broad data sets. AI is going to be tremendous there. And then more broadly, as you think about reaching into underserved communities, thinking about access to credit differently, improving both credit outcomes and reaching into underserved communities, all possibilities for AI. Like most things, I'm not an examiner. I see all the opportunities. They see all the risk. I see all the opportunities. But it's important that we bridge those gaps because you've got to understand the risks. And so, from a regulatory standpoint, as state regulators think about these challenges, in many ways, it's traditional model risk management, right? You need to understand your outputs. You need to understand how your model works, and you need to watch you need to understand the inputs and then watch the outputs. And generative AI is only different in the fact that the model can change, and that to me is going to introduce new challenges for regulators. Models are getting more and more and more complex, and regulators are dealing with that every day. Generative AI, I think, just introduces new components to that. I think it's going to challenge the way we think about hiring. We're not going to be finance majors and accountants anymore. We're going to need data scientists. We're going to need IT specialists to understand the environment. One of the risks that concerns me is as you get more and more and more data and understanding how generative AI models run against that data. And from a regulator perspective, can you protect sensitive information? For if you're using it in the context of exams, can you protect confidential supervisory information from unauthorized disclosure? All those are challenges that we're going to have to face. So new risks, same challenges, same risk, just a new technology that we need to wrestle with a little bit.
No, that makes good sense. I mean, so what do you think, what should regulators be doing then, to encourage responsible adoption? Is there a role of like using soft power and kind of speaking? Is it the power of state regulators saying like this can be done responsibly and should be encouraged? So what are the types of things the state regulators can do? And what are those, and how do they start to mitigate some of the risks that you're identifying?
Yeah, Daniel, I think the first step is understanding and engagement. With any new technology, understanding how it works, making sure that your teams understand data, understand model risk management. I think that's our first step right off the bat for our members. But then engagement with industry, engagement with consumer groups, talking to experts like you're doing today, to get a better understanding of how the tools work, how the tools can be used in the future. I think that's our first step. And then allowing the technology to mature. I think sometimes there's a instinct among regulators just to say no, to avoid all the risk, and try to sort of push that off into the future. And I think you have to let technologies like this mature. You sort of have to pop the cork and let the wine breathe a little bit. And that's I think a real challenge in the space, because you want to make sure consumers are protected. You want to make sure institutions run in a safe and sound manner. And so balancing that risk and allowing technologies to mature is going to be key. At smaller institutions, certainly from on the bank side of the ledger, smaller institutions, we're seeing very little use of truly generative AI. Most of the work is on the consumer protection side. And, Daniel, one of the things that we've done at CSBS, because you're on the group, we've set up an AI advisory group. We've brought in outside experts from the technology space, from consumer groups, from IT, to understand and help us think about the challenges that we're facing. But allowing this technology to mature a little bit is going to be the biggest, I think, challenge for regulators going forward. But then the opportunities are immense, because how we can transform how we regulate industry, how we supervise industry, lots of opportunities there, I think.
So the work you're doing at CSBS to engage, how do you disseminate that to the states? How are the state regulators engaging in some of the work that you guys are spearheading?
Sure, thank you. So what we do, we meet with our AI advisory group quarterly. We have regular conferences and meetings with the states. So we have panels at our regular meetings. We send out our minutes. But what we're really trying to do, our sort of the first step with our AI advisory group, is we're looking at how we can use AI in the context of supervision. I always said at the FDIC, one of the biggest challenges that we face is in loan review. We spend 400,000 hours every year doing loan review, which is basically turning pages at financial institutions. And some of these are complex, business deals or lending, commercial real estate. All the loan packets are a little bit different. And could we use AI? I always thought, I don't want my examiners to be data clerks. I don't want them to be chasing data. I want them to be analysts. And so the ability to use AI to understand these large data sets, to pull insights out of data and let the examiners be decision makers, that to me is a real opportunity on the regulatory side. And then I think of stress testing, more regular access to data. The bank exam model in many ways hasn't changed since the 1860s, right? We get quarterly call reports and we go out and do an annual exam. If we had more regular access to data, if we were engaged with institutions across the time horizon instead of point in time exams, how could we identify and mitigate risks more effectively? When we were at the FDIC, I know which institutions have a concentration in CRE. They can point those institutions out to me on a map, but they can't necessarily tell me without going into the exam papers where those concentrations are. Is this a Minnesota bank with a concentration in real estate in Phoenix? Is that concentration in retail, or is it in office? And the ability to use AI to understand those risks and take actions to mitigate them, it just presents great opportunities. One of the challenges I think we face as bank regulators is we look broadly at risks from a horizontal standpoint, but each individual institution has different risk components. And sometimes translating that risk the horizontal understanding to an individual institution, it doesn't make sense, but we just pack that understanding down. If we can use technology to have a better understanding of individual institutions' risk, it will allow us to refine our supervision in a much more effective institution by institution way. It just introduces possibilities that are really exciting, I think.
No, your work has always been excellent on that, and this idea of modernizing the regulator itself is something I know AIR has done a lot of work in that space. And I'll say from my years back at the CFTC, we talked about the need of the agency to become a quantitative regulator, which meant if you're gonna regulate increasingly digital markets, you're gonna need to have those same tools to be able to keep pace. So I know you've been working on that for many years. Let me shift over to model risk management. I mean, have talked at the outset about these two papers that AIR and Google have partnered on. Um, Model risk management, SR 11.7 for those, bank compliance folks. That's something that's well known at the federal banking agency level. Are these frameworks well understood and applied as well at the state level? And I guess I should add too, like, are they fit for purpose when we talk about these technologies?
I think so, at least in the beginnings of this process. As I said before, in many ways, it's understanding the inputs, understanding how the model works, and then measuring the outputs. I think the interesting challenge that generative AI produces is how an institution and then how regulators understand the evolution of the model. As the model evolves, as new data comes in, as the model changes, and how does that impact outputs? And in many ways, I think we're going to have to get more comfortable as regulators, focusing a little bit more on the outputs, and then making sure that the institution is monitoring and understands the how the model is changing on a regular basis, and how we document that. It's that to me are the trickiest components of a truly generative model.
Right. And so to that end, when we think about MRM frameworks kind of evolving, obviously the effort in the paper is an industry effort to say, let's take that framework and let's try to clarify, how this would apply in the context of Gen AI. Talk to us about that process. Like, how do we add, greater clarity for banks, especially small banks that are looking to adopt the technology? You've worked in the past and talked in the past about, standard setting efforts or industry efforts in partnership with the public sector that can kind of put the meat on the bones of these evolving areas. Would love to get your thoughts on that.
Or, one of the things I've talked with Joanne a lot about is how we can use models to validate models. I think that's a great opportunity for us in this space. From a standard setting I've always been excited about public-private partnerships. I just don't feel as technology evolves that regulators are going to be able to keep pace from a regulation standpoint. If everything is APA, if everything takes time, it's just we're always going to be too slow. Regulators will always be too slow. And one of the things we did in the Homeland Security space is partnered with the private sector to allow the private sector to move the understanding of compliance and set standards, and then the regulators would step in, Homeland Security or the banking regulators could step in and then make adjustments on the edges. So the industry leads in the compliance space, and the regulators make adjustments as necessary. I think public-private partnerships are a huge opportunity, and standard setting organizations can be an important part of that. I mean, they've been around for ages. UL is there. We've got X9, we've got FDX, all these in the financial space already. But what's key is regulators sitting at the table, working with the private sector to understand a problem, letting the private sector roll, and then getting an input into the process. And then I think that gives certainty, to consumers. It allows consumers to trust those products and let banks work more effectively with third parties. It gives regulators visibility into the space that they don't have. Now, we're never going to have enough examiners at the federal level or at the state level to go into all these third parties, pull apart models. So you've got to sort of deputize the standard to work on your behalf. And so I think that's a real opportunity for regulators as technology continues to evolve.
And Brandon, you're at the leading edge of this and kind of helping lead the states forward. Do you have partners at the federal level with the federal banking agencies? I mean, because I assume it requires kind of all the regulators to work in tandem for this to really provide that clarity.
Yeah, we work with the FSOC, we work with the FFIC, we're dealing with certainly the Federal Reserve and the FDIC on a day-to-day basis in the field. They're tremendous partners. I think the opportunities now, I think the next wave of leaders at the federal agencies are more open to technology. You look at things that Acting Comptroller Hood has said, what Governor Bowman has said at the Fed, what Acting Chairman Travis Hill has said at the FDIC. I think it's a real opportunity to reset how we think about technology and use technology in this space. And one of the things we always say about the state system, those differences in opinions and differences in approach among the states allow for pockets of innovation, but they also allow these technologies to mature. I think there's a real opportunity now, right now, to reset how we think about technology and innovation in financial services. The states are ready to work with our federal partners, and I think there's a willingness now to lean in a little bit. And I think that's going to be good for industry and ultimately good for regulators.
Absolutely. All right. Well, we're almost at time here, but we weren't going to take questions, but I see there was a good question from the audience. So maybe this will be our concluding question. So Brandon, the question that came in here is, given your statement about wanting to look at data on an ongoing basis, what do you see as AI's impact potentially on call reports? As you said, that could be more dynamic.
Yeah. Look, I think we can get rid of call reports. I think we can get rid of them. I think we can onboard institutions, bring in new data, bring it in on a more regular and more granular basis. But there's got to be a benefit for institutions too. We've got to show them that with this more regular access to data, that we can cut their cost of compliance, right? We can be more effective, we can be more efficient as regulators, and we can cut the cost of compliance. One of the things we were looking at the FDIC was whether we could onboard institutions, get more regular access to data, and how would that change how we scoped exams? How would that change how we interacted with the institution over time? So if you see a risk spring up, you take action to mitigate it now instead of waiting until the exam is done. So I think there's a tremendous opportunity there to move away from quarterly call reporting. Now, we're still going to need some sort of public disclosure relative to the data, but if we can automate that process, if we can change the way we use that data in our supervisory, I think it opens up tremendous opportunities for regulators in this space in a way that cuts the cost of compliance. And oh, by the way, if we can do that from a regulatory standpoint, if institutions can get more comfortable in utilizing data in that way, it's going to prepare them to onboard new technologies themselves. For business purposes. The regulator can be sort of the leading edge on this issue, and that makes it exciting for me.
Yeah, I mean, you talk about like the possibility of like public dashboards or the more dynamic information. I mean, there's a lot there, and just moving this data in a more streamlined way.
Daniel, in Arkansas is one of my favorite models. Arkansas has a monthly sort of a mini call report, completely voluntary. Their institutions, they don't mandate this across the state. 97% of their institutions participate in this voluntary program. And why? Because they get good data from the regulators about their risk profile relative to their peers. And that's shared, that's a shared understanding of risk with the regulator. It's a great opportunity and something that AI can give for us.
Yeah, excellent. Well, we could go all day, but I wish I had like a round of applause button I could click here. But Brandon, thank you so much for joining me. This was a fantastic way to tee us off. I think with that, I will turn the program over to Chris Hoffensberger from Google, who's going to walk through some of the key takeaways from the two Google Air papers that we had referenced at the outset. So Chris, I'll hand it over to you.
Thanks, Daniel, and thanks to you and Brandon for opening the discussion today. Good morning, everyone. I am excited to be here today because, as all of you know, generative AI is transforming the financial services sector. It's bringing advancements in efficiency, security, and innovation. At the same time, we have to be mindful that it introduces risks that financial institutions and regulators must manage effectively. As the next part of today's discussion, I'm going to walk you through some of the key insights from our latest white paper, which we co-authored with the Alliance for Innovative Regulation. That paper is called Generative AI Risk Management in Financial Institutions, and it explores how existing model risk management frameworks can be adapted to address the unique challenges and opportunities presented by generative AI in the financial sector, and builds off a paper that we co-authored with AIR the year prior. That first paper focused more broadly on AI and finance, while our latest paper updates our thinking based on, I think we can all agree, very rapid developments in generative AI. Before diving into risk management, I think it's important to step back and define generative AI and why it matters for financial institutions. And with apologies to those of you who are well steeped in these issues, because I find that it is helpful when I use our generative AI tools to ask it to explain something to me like I'm a middle schooler. I want to start out by defining what generative AI is, because unlike traditional AI, which is in use in many places and in many sectors, generative AI creates new outputs. It does not just primarily analyze existing data. Generative AI can offer a range of possible outcomes based on learned patterns. It's a subset of AI that uses pattern recognition, context, and memory to generate that new content. And why are financial institutions interested in investing in generative AI? The technology offers several major benefits. Financial services sector stands to gain significantly from generative AI, with potential benefits including enhanced efficiency, better decision-making, improved customer engagement, and stronger security operations. Bottom line, in fact, 90% of senior leaders who are running generative AI in production report revenue gains of 6% or more. GenAI brings gains in several areas. It can automate repetitive tasks such as responding to requests for proposals, localizing multilingual content, and conducting compliance checks. It enables firms to extract valuable insights through advanced conversational interfaces and data summarization techniques. On the customer engagement front, I think we've all experienced AI-driven chatbots, which can provide personalized and efficient customer interactions and set new benchmarks for customer satisfaction. And of course, generative AI can enhance security operations by contextualizing the latest threats and supporting staff in detecting, investigating, and responding to cyber threats. So on that point of risks, while the opportunities are significant, our paper also discusses how Gen AI introduces risks that must be carefully managed. These risks fall into two main categories, some inherent to the technology and others related to how it's implemented. On the inherent risks front, these stem directly from the technology itself. They include things like hallucinations. Generative AI models can produce outputs that are factually incorrect and even nonsensical. Generative AI systems can unintentionally amplify harmful biases present in the data they are trained on, leading to skewed or unfair outcomes. And on the explainability front, generative AI systems are often complex and lack transparency in how they arrive at decisions. It makes it difficult to understand the rationale behind their outputs and behavior. Externally, those risks arise from the broader application of generative AI within the financial ecosystem. Data security, there are concerns about safeguarding confidential data from unwarranted access and exposure. And of course, on the regulatory uncertainty front, the rapidly evolving regulatory landscape constrain resources and impact the ability of institutions to quickly adapt. So how do we manage these risks? The good news here is that our paper advocates for continued reliance on well-established model risk management frameworks. These frameworks typically provide for model validation, governance, and control, and risk mitigation. Our first paper emphasized a few key takeaways while generally addressing AI adoption in financial services, including the importance of an initial risk assessment and risk tiering based on the application or use case. In assessing the risk presented by a model, it's important to recognize that AI models are not inherently more risky than conventional models. A risk tiering assessment must consider the targeted business application or process for which a model is used, as well as the model's complexity and materiality. The importance of ongoing testing. Due to the dynamic nature of AI models, reliance on extensive and ongoing testing focused on outcomes throughout the development and implementation stages of such models should be primary in satisfying regulatory expectations of fitness and soundness. And finally, the importance of modern governance controls. Regulators should use guidance to advance the use of governance controls, including incremental rollouts and circuit breakers, as essential tools in mitigating risks associated with risk AI ML models. I think Brandon put it pretty well when he talked about giving new wine a chance to breathe. So adapting model risk management to GenAI, building on the same themes and categories as our first paper, including model governance and controls, validation and oversight, and shared responsibility, the new paper offers a series of specific recommendations for risk mitigation. These include, on the socio-technical and considerations front, integrating technical and social factors to manage AI risks, balancing trustworthiness characteristics such as validity, reliability, safety, security, accountability, transparency, explainability, privacy, and fairness. As to data governance, the role of data becomes even more significant and pronounced with GenAI models. It's important to enhance the quality and quantity of input data for fine-tuning models, including data selection, cleansing, and enrichment. Clarifying model documentation requirements. Updating and clarifying model risk management guidance to specify documentation expectations for generative AI models, and grounding AI models in verifiable data. By anchoring model responses to verified data sources, we can reduce hallucinations and enhance trustworthiness. And in continuous testing and monitoring. Risk management doesn't stop at deployment. AI models require continuous validation to detect anomalies, prevent bias drift, and maintain reliability. The paper highlights a few techniques, including penetration testing and red teaming, where we incorporate those tools to identify vulnerabilities and test the organization's incident response, which can help enhance security measures. And robust model monitoring, whereby continuous validation and monitoring of AI outputs against expected results and known data points is critical for maintaining model reliability. Another essential safeguard is model evaluation. The paper recommends using quantitative and qualitative assessments to understand how well generative AI models align with their intended tasks. And of course, human-in-the-loop oversight. AI should augment human decision-making, not replace it entirely, especially in high-impact scenarios. It's important to implement continuous monitoring, robust testing protocols, and human-in-the-loop oversight, including manual reviews in such high-impact scenarios. Advanced fairness metrics. Fairness in AI models is crucial for maintaining trust. Continuously monitoring for disparities in model outputs across different groups can help maintain fairness and present bias. And safety filtering. Ensuring that generative AI models don't generate misleading, biased, or harmful content is another critical priority. Using safety filtering mechanisms to prevent the generation of inappropriate or harmful content is key. These strategies, strong documentation, continuous monitoring, human oversight, fairness testing, and safety filtering, help ensure that generative AI is trustworthy, compliant, and secure for financial institutions. So finally, looking ahead, the conversation around generative AI and financial services must continue to evolve. Here are some potential next steps that we outline in the paper. On regulatory clarity, we believe that regulators can provide further guidance on documentation requirements, model evaluation techniques, and controls for safe AI implementation. We believe that collaboration is important. Industry participants, regulatory bodies, and technology providers should all continue to work together to promote the responsible adoption of generative AI. It's important to focus on external risks, where we believe there should be a further examination of the external risks associated with generative AI, including systemic and operational challenges. We believe it's important to set up pilot programs and case studies that would allow and encourage financial institutions to successfully implement generative AI risk management frameworks. And finally, workshops and training. Workshops and training can help educate stakeholders on the latest developments in generative AI and risk management best practices. So finally, in conclusion, generative AI offers significant opportunities for the financial services sector, but it also presents unique risks. By adapting existing model risk management frameworks and fostering collaboration among industry participants, regulators, and technology providers, we can ensure the responsible and beneficial adoption of generative AI in finance. And with that, I'll turn it back over to Joanne to advance today's discussion.
Thank you so much, Chris. That was great. And for everyone who's hearing about the paper, you can find the paper on AIR's website, which is regulationinnovation.org. And the first paper, of course, is there as well. I think these issues are so interesting because, in a way, generative AI is sort of democratizing AI, with more and more people seeing opportunities to use it and using it, and therefore creating a lot of challenges as well as opportunities. So to talk about these issues from the standpoint, especially of the financial institution, we have our panel coming up. We're going to have the perspective of technology, the legal issues, and the institutional issues as well. So I want to introduce our panel. David Stone is the Director of Financial Services from the Office of the CISO at Google. Anna Grisel is partner at Paul, Weiss, Rifkin, Wharton, and Garrison. Welcome. And Kelvin Chen is SVP, and Head of Policy at the Consumer Bankers Association. So welcome, all of you. It's great to see you. And I'm looking forward to a robust conversation. We're going to start by talking a little bit about the use cases and adoption that we're seeing so far in financial services. And David, let me start with you from the standpoint of the provider. What are you seeing primarily in terms of the early applications and development, adoption, and what's growing, and what are the areas maybe that are slower so far?
Yeah, thank you. And first off, thank you for having me and Google on the panel here to kind of talk through those things. Very much appreciate the time and kind of the opportunity to speak to everyone around it. So in AI, as you can imagine, there's been monumental growth on the number of use cases over the last 12 months, even more so within that. I think some of the financial services adoption and some of the things that we would say here won't surprise you too much, right? You've seen like the chatbots, the interactive things. How do we become more efficient as an enterprise on the things that we need to do, whether that be internal and the processes that we have, but we also have a lot of use cases that are coming up around how do we become more efficient to our customers, right? Across those various different aspects around it. It really has, I think, unlocked a lot of potential for the transformation of some of these financial services into the next generation of where they want to be. The technology has caught up on a lot of these things that they can think about. How do we automate those processes? How do we look at that? Always with the human in the loop and those types of oversight. But then also the opportunity around broad exploration where they might not have that to date. Things about being able to chat with your data, right? Or ask natural language questions of your data and get responses back of various different insights. And that not be a 6 to 9 month project, that be more of a, hey, I'd like to know this now. Can you return that back and let me review it? Those are the type of opportunities that we see a lot emerging within the field. Mentioned before too, we're also any place where there's big data opportunities. One of those areas that's near and dear to my heart, cybersecurity, is one of those opportunities where It has the opportunity to make teams more efficient, and make them be able to see more into the environment and be able to ask questions of the environment that they might not have insights to today. There's also technology out there today that they are leveraging that's been around for a while, right? There's things that AI has been inherently built into some of the products and things that they already use today. So a lot of opportunity there. I think that I think the paper quoted over 300 billion in opportunity for revenue across that. And I think that that's probably at the beginning phases, right? Like we're letting it breathe from the example earlier of taking a minute. I think those opportunities will only expand, and it will become more and more embedded into our lives, and more naturally so, right? We won't so much be seeking out AI experiences and generative AI experiences, but they'll be part of our daily life to help us become more productive.
Yeah. Kelvin, let me go to you with the same question. What are you hearing from your banks as far as adoption and use cases that people are most excited about, and maybe ones that they're not confident in yet?
Sounds great. And I should again start by saying thanks so much for having us here, Joanne. And just for context for your audience, so our trade association is retail banks, and we are banks of $10 billion plus, all the way up to the very largest banks. But we're generally focused on where banking hits consumers, and so there's probably all kinds of operations for other types of banking that I will overlook here. This is my categorization, not even anything that we've put in our materials before. But in prep for this, I was like, oh, it kind of falls into 3 buckets as to how I think of our general lists of usage of AI tools. There's what I would think of as the low-hanging fruit, and where there's a lot of just ample opportunity for further work. And that could be things like marketing, like creation of marketing materials, like image generation, copy text, and the like. To David's point, just a lot of great opportunities for back office, everything from data entry, coding, report generation, analysis. But then there's this second bucket that I'm pretty excited about, which is what I kind of think of as AI chasing AI. And so that goes to cybersecurity, everything from monitoring just kind of weird anomalies for inbound and outbound network traffic, similar monitoring for AML work or fraud detection and the like. But the reason why I like that bucket a lot is when I was in the government and we were trying to talk with policymakers and explaining to them why explainability and transparency would need to be on sort of a sliding scale. I remember having a conversation with a very senior person in government, one of our agency heads, trying to explain to them, saying, look, like, if AI is going to be ubiquitous because cloud computing power is cheap, data is super ubiquitous, and the algorithms are free, they're open source. And so the bad guys will be using the tools just as much as the good guys. And so if we need to have good guy AI chasing bad guy AI, and ours has to be fully explainable and fully transparent all the time, we'll always be 10 steps behind. And that was an analogy that we wrote a lot all the way through in helping explain to folks why frameworks like model risk management really need to be risk-weighted. And to this particular agency head, to kind of give them credit, they paused for a minute and they said, wow, it's sort of like the Borg phasing in and out of shift. And Joanne, I got to say, it was like one of these moments where like, oh, this is like a very deep cut. It's like not just a Star Trek analogy, but like a season 5 Next Generation deep cut. And so you really had to change your presentation at that point. But so that would be the second bucket, basically AI chasing AI. But then there's this third bucket where it's really where you've got AI hitting highly regulated areas that impact a lot of the consumer regulations from the late 70s or the mid to late 70s. And so that would be using AI tools for consumer complaints, using AI tools for lending. The thing I would note there is that folks are in that space, and we'll talk about some of the impediments there, I'm sure, later on in the panel, but people are being very deliberate and cautious because they're very mindful of the various considerations that are in that space.
Very helpful. I love the point on AI chasing AI. And I think, you have so many conversations about AI where people are raising all the problems, why it's going to be difficult or impossible or whatever. And very often it seems to me the answer is you're going to have to solve that problem with AI. We shouldn't think of it as something that we're going to going to address with our traditional tools. Not fully. Traditional principles maybe, but not all the same tools and data. Anna, let's go to you. I am sure you are in demand with your clients with many, many legal questions. We're going to talk about the regulatory issues, but what are you seeing so far in terms of the most rapid adoption and less so for other things?
Yeah, thanks so much for having me. For folks who don't know me online, I'm Anna Gressel. I'm from the law firm of Paul Weiss, and I am a partner who leads our AI practice. So we work across industries. We're not necessarily just in banking, but we have banking clients. We have financial services clients more broadly. But we also work with technology companies in automotive, manufacturing, pharmaceuticals. So we see a lot of adoption across a lot of different industries, and there are definitely some trends that cut across all of them. I think everyone's interested in AI, and probably from the folks listening on the line, you'll recognize that for many companies, we're still in a piloting phase for many tools. We see a lot of companies that are deeply interested in adoption and are trying to figure out how to make this work, how to actually roll out AI across their enterprise. And so some are still piloting tools, some are really in adoption mode and have actually done the pilots and done some of the rollout. But it is often the lawyers and the legal issues that are raising certain questions about how AI can be kind of safely and securely used. I would actually say security is another major gating function that we see in terms of actual adoption, making sure that these tools are secure enough to use for significant, meaningful, confidential information, for example. So these are big, the legal piece of this can be a major driver. And I think it's important for the non-lawyers on the line to remember to engage your legal colleagues. But in terms of, what we see on the adoption front, there's a huge, and this should resonate, I think, with folks, there's a huge interest in adopting in what I would call an agile but compliant manner. So a way in which organizations can actually get in there, start testing and start learning from the products what they can and can't do, but at the same time, making sure that their regulatory risk, their litigation risk, and other legal risks stay within a tolerable level. And that depends a lot on the use case. It depends a lot on the business line and the business unit that the use case is being deployed to and what the specific regulatory concerns are there. And I think from our perspective, the companies we've seen succeed in being able to do this are able to take a very risk-based approach. They're able to say, hey, even though this tool might cause concerns in a particular business unit or with a particular stakeholder group, or we need to think about additional guardrails or constraints in those contexts, actually, this is a pretty multi-purpose tool. And there are lower stakes ways that we can deploy that same tool. And so something that's a very flexible multi-purpose tool could be pushed out to certain groups first. And there can be learning from that. And learning can be incorporated into then the higher stakes deployments to make sure that the company really knows how that tool is going to work in practice. The other thing I would say is just making sure I think, workforce implications were mentioned a little bit earlier. I think some of these tools can actually raise concerns from employees about what the workforce implications will be. What we found also on that front is there are a lot of tools that are meant not necessarily just for efficiency purposes, but actually what I would call challenger tools. They're meant to make us better, to make to make sure we don't miss blind spots. We even have some clients that have deployed tools at the board level that are intended to make sure that there's not necessarily bias, even in board decision making. So that's what I might call a high stakes use case, but relatively low stakes in terms of the deployment because people are still exercising their own judgment. And so there are ways in which you can balance from a legal perspective some of the risks with opportunities by making sure the right decision processes are in place, the right oversight is in place, and that these tools are used kind of in a way that doesn't just replace humans, but augments them. So, these are not necessarily traditional legal questions, but they come up a lot in our legal work these days because process is so important.
Yeah, it does seem like there's an arc of adoption that is most people starting with lower risk use cases, learning from that, as you say, and then kind of building confidence and knowledge. So let me stay with you. You've already touched on a lot of this, but when you think about the regulatory frameworks that we have and which are evolving really, or going to be evolving, I think, in this area, what are the areas where you think there's the most legal and regulatory uncertainty that may be having And is that a good thing or a bad thing? Or maybe you don't want to opine on that, but
No, it's a great question. I think some of the uncertainty can actually be helpful because it, and this is a very lawyerly response. I think it brings lawyers into the conversation to talk about what it really means from a practical perspective to take that risk down. And so often, and I'll say this as a lawyer who also advises tech companies, like so often the solutions can actually be architected into the tools. And so I think those conversations are worth having, and it's worth having really smart minds together saying, well, we're really uncomfortable if it works like this, but actually we could just change the interface. And then we can all get really comfortable with what that tool does, what kinds of disclosures it provides, what kinds of information it takes in, for example. So much of this is just about making something that is a general purpose tool kind of fit for purpose in your environment. And the more folks dig in on that, I think it can be extremely helpful. In terms of the higher stakes use cases, it of course depends on the regulations that I think people are grappling with. A lot of what we see uncertainty around actually these days is regulatory expectations kind of amidst a changing landscape. And so kind of supervisory expectations, potential enforcement risk. I think we see significant discussion about that and questions about how that's going to map on the technology. That the reason for that, I will say in part, is also because the technology continues to change. And so one way to think about AI is, it's a big bucket, but it's also a point in time. So, things keep getting added to the bucket of what might be considered AI. We're talking about agents now. We weren't talking about them before. But, those tools continue to advance, and ChatGPT, the moment that was released, seems like a long time ago for many companies. Now the tools are even more sophisticated, the capabilities are more sophisticated, and many of them are multifaceted. So, mapping the regulatory landscape, against a tool that in a way continues to change, I think that's often the hardest piece of this. Because as soon as legal departments feel like they're wrapping their arms around what AI is, AI changes again. And the technology changes again. So figuring out, I would say I'm a big proponent for governance, and figuring out a governance model that can really adjust for that kind of quick, very fast-paced regulatory change, fast-paced technical change is really critical, because you have to be able to look again and again and again and again at new paradigms. And so really smart governance, really smart folks who are kind of in the mix together working on this, and can create consistent risk-based calls for the organization. That often tends to be a very, very practical and helpful lever.
Yeah, we're going to actually talk about governance in a little more depth in a few minutes. But Kelvin, let me go to you on this question of regulatory clarity or ambiguity. You are a former regulator, as am I. You led the innovation work at the Fed originally. And I think you probably share my sympathy with the regulators. And this is not easy to, the industry would like clarity on what they are and are not allowed to do or how to do things. And yet, as Anna said, the issue's changing constantly. But are there certain pain points that you would highlight right now that where you think there's a need for regulatory clarity, or lack of it may be preventing good things from happening?
Absolutely. And, I would note I would flag the great kind of thought leadership that's put out in the papers that you guys have been working on with Google Cloud. And I think a lot of the notion of just helping people understand. I mean, there's almost semantic discussion about whether there are some models that aren't models, or whether or not it's just a matter of risk tiering models. And so, but there's a lot of clarification that you can be thinking about on the model risk management side, that both Anna and David have alluded to. What I would note, though, is that, Joanne, as you know better than anyone else, regulatory expertise that really differs, and the silos really differ across our regulators. However, technological change is ubiquitous. And so, I think one of the things that we're really having to kind of break down right now is how we face down regulatory silos that may impede different pockets of the industry that are all trying to accomplish similar services, particularly because they're relatively indistinguishable for consumers. And so, one way of looking at this is kind of the argument about whether or not there needs to be a national framework for AI as opposed to state-by-state regulation, or even municipal, like city by city, right? New York City have their own regulations on AI, and there's a question as to how tenable that would be. But the thing I'd really focus people on is bank versus non-bank. All of our discussion about model risk management, which I think is wonderful and incredibly important, and it's a great and productive conversation between regulators and supervised institutions. That only arises in the context of prudential bank regulators and their supervised institutions, meaning just banks, right? And so there you've got basically a 14-year history of the guidance and examinations. And so we're having some pretty complex conversations about how you risk here. There's a lot of language and vocabulary for it. On the other side, you have non-banks that to consumers often produce the same types of goods and services. They have no, unless you're a vendor of a bank, and there's a whole separate conversation about third-party risk management and kind of how that bridges one over the other. Non-banks generally don't have any reason to be versed in model risk management principles. They certainly aren't examined for them. And so you really run the risk of a very different set of ecosystem, like a different ecosystem of norms and expectations there. And so this is one of the areas where, and this is such a tricky thing coming from like a trade and an industry person that generally should be kind of peeling back regulation left and right. But this is an area where clean and thoughtful regulation could actually could be sort of a good platform to help create more consistent treatment and expectations, regardless of what the entities are. And so, having folks like at the CFPB, where you've got a lot of experts that have very strong opinions about AI, but have them get more well-versed in things like MRN and maybe even start issuing a non-bank version of MRN could really be very helpful in clarifying some of the huger regulatory gaps as we sort out some of the kind of spackling and trim on the prudential regulatory side.
Yeah. David, let's come back to you. You are straddling the tech world and the regulated financial world, and they are very different in terms of cultures and speed and everything else. Brendan talked about this earlier as well. And your customers in the financial services sector really need to be able to trust the tools that they're getting in this space. So share with us your thoughts on this issue of regulatory clarity, and then maybe segue from that into going a little bit to the governance questions and how to be sure that the work that's going on in this space is trusted and trustable.
Yeah, and thank you. It's a great question. And we work with a lot of financial services routinely, right? So both banks and non-banks and different types of financial institutions in various different areas, right? So this area comes up quite a bit. And one of the things that we always emphasize as we do that, right, is you can always build trust off of your programs. You have mechanisms in place today that help you on some of these core key issues, like data governance and being able to control data and all of the things that come within that. There are pieces that AI does add into that conversation around how do you control the model? How do you ensure that it's trustworthy? How do you ensure that your data remains your data, both in anything that you train across that, and then the inference and kind of the questions that you ask back and forth. There's a lot of different layers of controls that we work with on financial institutions. And I think Anna said it very well. It's a risk-based approach, right? If you have an internal chatbot that's helping speed up operations, there may be a different level of risk to that than something that may be exposed publicly to customers to help them with that type of interface, or even something that's assistive in technology, right? As a human-assisted technology aid, that we've seen lots of use cases that have proven very valuable in terms of both the quality and effectiveness of working with customers and working internally to get consistent answers. So I think that there is a huge upside on the potential opportunity and the actually de-risking some of your processes and getting consistent answers around that from both a customer and an internal consistency perspective. So there's a lot of actually positive risk benefits as a corporation that you are de-risking. Now, how do you then trust the AI and the generative AI that's generating that? There's a lot of different approaches here. One is around transparency, right? Getting model risk cards around how does this model operate? What's the effectiveness of this model? Can you alter things like controls inside of that model to change the temperature of the answer, right? Or say, okay, I want it to be more conservative in this case and maybe be more liberal in the responses in this. And you can modify those parameters for those use cases. And you can also take a look at different pieces of that. And maybe we'll go into a little, I think maybe later, but things like grounding have a huge impact of making sure that the answer has the context of your environment in order to answer that question meaningfully and with a high efficiency rate, in order to make sure that it's really hitting the point and it doesn't go down a path of like hallucinations, right? And it can say, hey, I'm not going to answer that question for you based off these parameters. There's a lot of controls that we work with financial institutions with, both bank and non-bank, on how do you actually do that, right? How do you work through those set of controls? And then I would say that last piece of trust really is around industry groups like this, right? Making sure that we're transparent about those things. We're joining those groups, we're engaging those conversations, we're engaging with regulators. We're also engaging with the industries around AI, NIST and others, to ensure that consistency across the board. So I think that there's a lot of things that we can do based off the techniques that we already have today, and then adding on those AI level controls and getting clarity around, okay, for that risk case, what's actually impactful, and then how do we mitigate that risk accordingly? So a lot of things, I think, that both sides of that equation, but it's really a risk-based approach based off the use case. Summarizing 10Ks across all financials or all companies might be one use case, as it might speed up someone, but then also call center agents' assistance of summarizing calls, of helping provide that script that's a little bit more consistent. All are valuable things, right? So how do you measure that risk and then have that human in the loop to make the decision?
Since you touched on hallucinations, I think it would be worth hearing you talk a little bit about how do people get real confidence that there are not hallucinations without having to double check every single thing by a human being?
Yeah, that's a great question. And, it's almost interesting because we may have already had this problem in society before, right? When you ask a question of like 10 people, you may get 10 different answers, right, across that. So how do you discern some of the information? So how do you move that to the AI era of fact checking in those different places, especially around hallucinations? We've seen that grounding is very effective in terms of grounding the response of whatever that generative AI is in your corpus of data, has turned out to be a very effective way to reduce it. I mentioned before the controls. So you can actually, within models, say, hey, I need you to be 100% confident in the answers, right? You're going to lose some of the generative AI creativeness on the flip side, but I need you to be confident that this is going to be the answer consistently across a flow based off regulatory and other considerations, right? So you can actually put those controls within models to figure that out. You can put controls around the model, around how you ask the question or which things it will respond back to. And I think that also that model cards and other things give you transparency into the effectiveness of the models and others that really help ground that conversation around it. And from that perspective, there is a lot of controls that we can put around this that can make it a very deterministic path versus a very creative path, depending on that use case, right? And we've seen both ways in terms of, hey, what's the use case on this? What is the most benefit from a business perspective? And then how do we work into the risk level of how do we make sure that it's controlled effectively and the human in the loop really can look at those things. And the last thing I'll add in here is just automation of controls, automation of testing. If you've got, something that you are expecting a result back, having test cases that routinely ask questions of it and making sure that the responses are what you expect them to be, we see that as a very effective control and an outcome-driven approach of, is this performing the way that we really expected it to? Great, we've got test and use case that prove out, yes, it is. And we run them continuously on that model.
But touches on Kelvin's point about AI chasing AI. You can use a control model as well. Anna, what would you like to add on this issue of transparency and governance? And I'd love to hear your thoughts specifically on explainability as a goal and how easy or hard is that to accomplish. We've got some areas in finance where there's a legal requirement for explainability, especially in consumer lending decisions. So tell us how you're looking at those issues.
That's such a great question. I mean, we've been doing this. I've been doing this since 2018, and in the days of machine learning models, explainability meant something really very different and much more pointed. You could, even with large language models, kind of understand contribution of certain inputs to outputs. So why did the output come out the way that it did, and what was that really? What did that mean in terms of the inputs? And there was a statistical process for that. You could constrain that, and so explainability, I think, was something that folks began to feel like they were wrapping their arms around, and generative AI changed that in meaningful ways. There's a lot of research being done. I think it's worth, it's worth taking a moment and pausing and saying generative AI research is still continuing alongside generative AI product development. And so there's really meaningful research being done that's trying to get at what we might call interpretability of output. So what is the actual meaning of the output, and why did the model reach that conclusion? But at the moment, I would agree very much with David that much of what we're doing from an explainability side is about either understanding in the aggregate how the model works, or constraining the output so that we know that they're the right outputs, and it doesn't necessarily matter from a technical perspective exactly how we reach that conclusion. We kind of reach a more defined output. And I think in the fireside chat, there was a comment like we need to focus a lot on the outputs of these systems. I think that's true in a more black box environment, that the outputs become increasingly important. And what we're really talking about is explainability of the output, even if the process is less transparent, less of the glass box that we used to aspire to have from an AI regulatory perspective. So I think there is a practical reality around that. But so much of what David said just resonates with me, Joanne, in terms of not only constraining the model and the way the model works, but recognizing that almost every single AI model is put into a product. It's put into a user interface. It's put into some sort of software, or actually a physical system for some of our clients. And that is more often where a lot of these controls come into play, and where a lot of the predictability and the constraints can be put in to make sure that these models operate as intended or as expected. They're about making sure that users understand what they're asking the model to do, that the model actually acts in a way that is consistent with those parameters. And that doesn't necessarily mean like the whizzing and whirring in the engine of the model, but its actual product itself acts in the way that you expect. And that the outcomes or the outputs of those models are predictable, usable, checkable, right? You're able to kind of click through and check what the output was if you need to. But there's a bigger overlay on this too, which is also, what are you teaching your employees to do? What should your policies say about this? And how well do they understand the limitations and the risks of these tools? And right now we rely a lot on kind of education. We're kind of educating up a whole workforce to do that, and clear policies that are kind of consistent with how the products themselves are architected, even if the tools are not necessarily completely, or the models are not completely explainable. So I think there's a whole organizational system that kind of has to come together to work well on that. But I will second David that increasingly we talk about governance. I mean, we always talk about governance in terms of all of those facets, but increasingly it's kind of product level governance that can actually provide some really nice tethers for organizations that are trying to figure out how to do this in a way that, takes the practical risk down and also is administrable at an organizational level and not just at an individual employee level, which is, I think, a tough thing for organizations.
A really interesting insight. I haven't heard anyone say it quite that way before. You need governance around the models and around the products, and you need to make those dovetail. Kelvin, talk to us about how this looks from the standpoint of the bank trying to develop proper governance, assure proper transparency. And there's an issue I think someone touched on earlier, but we haven't really gone into, which is working with third party. Well, you touched on the fact that some of the third parties are coming from a less regulated and supervised environment and so on. What are the key things that we should understand about what the banks are grappling with and how they should do it?
Yeah, absolutely. And sorry to keep coming back to this notion of the need to create some sort of MRM style understanding for non-banks, but I think that that's a good example of kind of where we go from questions that are difficult, but kind of I view as sort of plus or minus 10% questions to questions that are kind of like plus or minus 50% questions in terms of like how varied and hard the answers can be. I would use an example of kind of what you're facing down with respect to some of the non-bank expectations. Last year, the Department of Treasury put out a request for information on the use of generative AI in financial services. And so a request for information is literally just asking people to send comments in and provide some clarity as to just what they're doing and what they're seeing out there. The CFPB, which is the primary consumer protection conduct regulator, put in a letter, right? So that's literally, it's going to be akin to like a letter to an editor. They sent in a letter talking about generative AI, and 95% of the letter is kind of what you would expect a consumer protector letter to say, right? Like just because you're using AI doesn't change your obligations under federal consumer protection law and the like. But then kind of midway through the letter, they say, so therefore you should be fair lending testing any AI models that are used for things like fraud, which on the one hand, right, like, okay, like that it's hard to argue with that because there are some impacts there. But on the other hand, no one really has any clarity as to how you would go about doing that. And absent, it's a very strong statement that one, like a large part of the market could have just missed because of it didn't come out in the Federal Register, or it didn't come out in the form of an actual rulemaking where you get the benefit of Administrative Procedures Act kind of notice and comment. But then there's this broad question of like, okay, at what point do you bake that into your processes? And how do you then sort of trade off the consumer protection elements of fraud with the anti-discrimination consumer protection elements, and how do you basically quantify those and put some process around that? And so that's just one example as to how you could see some benefit from having greater clarity on the consumer protection side as it relates to model risk management. Is that helpful? And I would note just kind of anytime where you have those intersections of you're kind of dealing with an MRM style issues with other types of considerations like discrimination or the need to some of the other outputs that like protecting consumers from fraud and the like, trying to understand how you trade them off and in a way to do so that is repeatable and defensible for an industry as a whole, as opposed to on an individual, like company by basis. Like helping provide that clarity, I think would be enormously helpful.
We have a couple of questions coming in from the audience on the topic of fraud and scams. And I'd really like to ask for any of you, we seem to be in a situation where fraud, money laundering, and scams are all increasing, and they're all being facilitated by AI techniques. We're seeing the advent of romance fraud and scams that are using deep fakes and voice cloning and so on. And we touched earlier on the fact that the answers to dealing with those are probably going to include a lot of AI techniques. Anna, you were nodding your head first. Do you want to speak to what are the opportunities there, and what should a practitioner today be trying to do or move toward doing as they grapple with this?
It's a great question. I was chuckling in a way and nodding because I saw a demo for a product the other day that was like a real-time a real-time video platform. I don't know if others online have seen it, where they were able to do some like AI face swapping detection in app. So the idea is if someone's on the phone with you, you can maybe get a warning from, say we're on a Zoom platform right now, a platform like that could tell us, oh, actually, that's not really Anna. That's, her colleague pretending to be her on the webcast. This is actually me. But the idea that we're really going to have to start relying on detection techniques to keep up with our, with all of different changing ways that this happens out in the wild by bad actors. I do think that is true. I mean, I think there are challenges with detection, but I think it's critical. I will also just say, from a legal perspective, I think it's also critical that courts have access to these technologies, because these are not technologies that only happen in the moment, kind of at the point of fraud, but there is also going to need to be real resourcing of the court system to figure out what was or what wasn't fraudulent in cases as they come up in the courts. And right now, courts are not all resourced to do that. Not everyone has, enormous law firms that can battle these things out and hire their own experts. So I'm a big believer that that's going to be an area where we can help regulators, we can help courts, we can kind of generally resource our government to make sure that they understand what is or what isn't a fraud. And this is a problem kind of across societies. I also think there's some great education going on. I was just in the UAE, and they have really public ads everywhere warning about AI-enabled fraud and making sure that that folks don't fall victim to those scams. So some of this is so important from an educational perspective, and particularly around certain areas of the population, like older folks who may not know kind of how pervasive these technologies are, just making sure they understand too the risks of them. So there's much more to say on that, but those are just two thoughts for me.
Yeah, your point on disclosure or making the consumer aware of what they're actually seeing is a great one. One of the things we've wondered about, and David, maybe you have a view on this, is whether we could evolve toward consumers having their own AI agent or some sort of shield protecting them or alerting them at least of risk. How are you looking at these fraud and scam issues?
Fantastic question. So I think that this is one of the key areas AI can actually really help. So we've actually been involved with financial institutions to help leverage AI and machine learning and other things in order to detect more fraud in the system from an AML perspective or other types of perspective. If you've seen some of the news, even just a couple days ago, we've started embedding models into things like Android phones that are on device that detect certain patterns and recognition and flag fraud from both a chat perspective and even sometimes the voice perspective around that from that. Now, obviously, handling all the risk and concerns around privacy and it being on model that basically all the data stays there in a protected area. Obviously, it's something that needs to be thought through and be thought through that risk profile, but it really provides an opportunity for this to catch up with where the fraudsters have been for quite some time, to be candid. Right? AI did not invent fraud, right? Fraud has been in the system for quite some time. I think one of the challenges is potentially the leveraging of fraudsters to use AI to make it more effective. But the channel and the mechanisms that they are doing it in today have existed for quite some time. And AI actually gives people a chance to detect those things and be flagged against it in a more consistent manner. So it's a huge area of opportunity. And we do work with a lot of financial services institutions around how to combat that. In fact, we just came from one of the financial services conferences around information sharing, and that was where fraud was a huge work stream of how do we partner on this? How do we get more and more institutions using this to combat this and be more effective? Because we've got proof and use cases that you actually increase the efficacy of detecting this fraud and you can shut it down with more consistency in the same amount of people. So like this is a great example, but again, we have to work with those institutions on how does the risk profile meet their institution in order to implement the technology. So all the controls that we were just talking about, all very relevant to that conversation of, okay, great, this technology exists, we can make it more effective. How do we put the controls in place in order to make sure that it's there with that human in the loop supervision as well? So a lot of different aspects to go off of fraud. I love it. go after the fraudsters all day long.
We have been doing a lot of work on fraud at AIR, including we did a tech sprint on payments fraud in West Africa and consumer protection late last year. And then we've got a project coming up we hope people will watch for in June, which we're calling a battlefront, where we're going to have competing teams of good guys and bad guys using AI. You talked about data sharing, and one of the theories that we have had is that we're never going to really get traction against these crimes unless we can have more data sharing among the good players, the banks, with each other, even internally at banks. There's often not data sharing between like AML and fraud teams for various reasons. And then with the government and then across borders, because these are global problems. David, just staying with you for a moment, do you feel like we are at or not yet at a point where we could have much more robust data sharing and keep the data secure and private? Because that's the big obstacle, I think, is that the government and the responsible institutions have to be extremely careful about protecting the data and keeping it private also. Where are we on that? The privacy enhancing technologies and so on.
Yeah, and I think it actually really plays nicely into the AI conversation, right? So I think that we now have technology that allows us to keep data secure and private to the institutions. And for all the reasons you just mentioned and all the legal concerns around privacy, especially as it goes to victim information and other things, right? How do we share out fraudsters, tools, tactics, and kind of how do they operate in the environment without sharing anything private around that? Yes, I have seen solutions, and we continue to develop solutions around enterprise grade controls that we can ensure privacy, we can ensure security. And the good part of all of this conversation, and maybe where AI maybe comes into the picture here on a couple use cases, is that based off of that federated learning model where institutions come together and pool their data and pool the fraud tactics that they have seen against them while keeping their data private, can actually generate a more efficient model across the industry on how to detect fraud. So we've seen that play out. We've seen very positive use cases around those things. And I think it's an area that we just have to like double click in and go all in, because the more of us contributing to this type of data, and we've done this in cyber for quite some time in the financial services of sharing cyber data about bad actors in the environment, threat intelligence, all of those good things. The same is true of fraud data, but now we have tools to preserve privacy as well as security and potentially generate models that are beneficial to the community using AI. This is a perfect time to think about, is our approach working at scale, and can we make it better at scale using AI and these technologies?
In anti-money laundering, our current approach is not working. If we look at the statistics like from the UN, we're spending a lot of money on AML, and we're not getting good results. We need better data and better tech. Kelvin, let me ask if you've got anything to add on the fraud and scam topic. And then there's also another question I want to ask you in the chat, which is, should financial services vendors and third-party providers have to disclose that they are using AI models in their software and products? And there are some small banks that may not even be aware that the AI is even in there.
Thanks, Joanne. Great questions. I am decidedly a much more low rent than David and Anna in terms of like my understanding of the world and my sophistication. And I am optimistic that there's a lot of really good that we can do with much um, uh, less sophistication in the tools that we use, just because there's so many great opportunities right now. There's sort of like an 80-20 effect, I think, when it comes to scammers and fraudsters, where some probably 20% of bad accounts are sending out 80% of the messages or more, right? Like, because it's just economies of scale. They're going to be on a romance scam. And it's been a while. I've been married for a while now, but I imagine that if you've got someone that's on a romance site that's sending out 10,000 messages a day, right? Then that's a person that you can relatively easily identify and then get out to other folks. And that there's a small number of institutions where you can kind of share that information without having to harden it, coming up with holistic solutions, right? That you can pretty easily identify bad actors at a couple of institutions. So that's sort of a separate fraud conversation and scam conversation, but I'm optimistic that there's some really big gains that we can get there without having to go as deeply into the tech as we need to. To your point on whether or not third parties should be required to disclose how they use AI, whether they use AI models or not, I would come back to, I think, the first principle of kind of risk management being that I think it's a matter of the risk tiering side of things, right? Like, what's the use case? How's it going to be deployed? There's a world in which, I mean, the kind of the amazing thing, I'm pretty sure in model risk in SR 11.7, it already contemplates that there are areas where you wouldn't be able to peer into the vendors' models, and they were thinking about it from a proprietary perspective. But I think the same thing would apply in this case. I love that the AIR paper talks about circuit breakers. That's something that we tried to talk about when I was in the Fed. So in certain use cases with certain types of things, I imagine that it might be fruitful and more efficient and kind of better for everyone to say, okay, we won't necessarily peer into how you're doing it, but just know that, like, if all of a sudden your gardener starts making massive changes to the building, the foundation of your building, then, like, you got to stop and say, hey, vendor, like, is this what you were contracted for? Then let's take a look at your toolkit. But otherwise, if it's just the equivalent of like an AI gardener, then maybe you don't need to look in to see how they're doing things.
We only have a few minutes left, and we brought our earlier speakers back on the screen, and we have a whole bunch of wonderful questions in the queue that we're not going to have time to get to all of. One question is, we touched a little bit on privacy, but one question for any of you is, what are the challenges and things that people need to understand about the privacy considerations for all this? And I'm going to give that to whoever speaks up first, since we've got, since I know you all could answer it. Who would like to take that?
That's all of us stepping forward at once. I'll just say from our standpoint, data security is on financial services is sort of a non-negotiable. And that is, I think, a risk that you have to be very wary of in this space, because of the way that these models pull information out and then could potentially disclose it on the other side. So making sure that your data is secure, that you're training models in a controlled situation, that when you're running models operationally, certainly on the supervision side, you're cognizant of how that data can be used on the other side. So.
Yeah, I'd echo that point. It's a non-negotiable, right? It's been non-negotiable for financial services for quite some time. And I would argue across the industry, it probably should be non-negotiable, no matter what industry we're talking about, is that the data of companies and people should remain inside of that organization and be protected with enterprise-grade controls. Those enterprise-grade controls should extend absolutely into AI today, right? Like that we've had to deal with those issues on other things, and we want to make sure that it's 100% private. It's no different in the AI. And I think that really emphasizes doing your homework on which models are you using, who's using them, right? Do they have that level of control based off the risk case that you're actually in the use case that you're trying to implement? Those should all be part of valid third-party risk management, as well as other processes that you have today.
There's so many
Hey,
more
Joanne,
questions. Yes.
do you mind? Kelvin said something earlier, and on behalf of the states, he's my friend. On behalf of the states, I have to say, he sort of hit the federal fallacy that just because there's nobody in Washington do it doesn't mean anybody is doing it. On the non-bank side of the ledger, the states are hard at work, including on model risk management, where they're talking about mortgage originators, money transmitters. There's a significant work program in the money transmitters regulators association, sort of the workbook for money transmitters. The states are on the job as it relates to the to model risk management. Now, does that need to evolve and get better and improve? Certainly, just like with our federal partners. But just because there's not a federal regulator doesn't mean there's not work being done in the states. Come on, Kelvin.
I appreciate that, and I appreciate you, Brandon. That's a really important point. Yes, sir.
I will observe that as a former deputy controller of the currency who worked only with national banks, I think sometimes we lose sight of the fact that our federal regulators our federal bank regulators and credit union regulators are dealing with the depository institutions and then looking at the fintech and tech vendor world through that filter. Whereas most of the state regulators are directly regulating both depository institutions and many of the kinds of fintech firms we see. And I think it does create an opportunity maybe for more cross-learning because your members, Brandon, are very hands-on, looking directly at the money transmitters or the fintech lenders and so on. It is a different lens. Well, I just used the rest of the time. Let me just say the paper again is at regulationinnovation.org. So is the previous paper. So is a lot of other interesting work from brilliant people like these. I cannot thank you all enough. I know this will not be our last conversation about AI, will it? So we'll be back. But we really, Google, we appreciate the paper, the work that you've done in really thinking through these hard issues. And we appreciate all our experts today, and we appreciate the audience. So thank you for joining us.
Thanks, Joanne.